Good morning, good afternoon. Welcome to the Freedom and Wealth Podcast. This is your host, Brian Nicolason. Thank you so much for joining. No, it's been a little while. We've been a little quiet over the last 2 months, and that's really due to big changes going on in the market. And we've spent the majority of the last 2 months doing a lot of research, doing a lot of academic work, understanding what's going on in the market, where our portfolio is relative to the rest of the market, and making sure that we're optimized and positioned for the next part of this cycle. Okay. And the cycle I'm really referring to is the massive super cycle, which is AI build out, artificial intelligence, robotics build out that again is fueling this super cycle, investment cycle. We've never seen anything like it. I mean, it's bigger than the internet. It's bigger than anything anybody ever seen that's alive today. This is going to retool the entire global economy. It's going to change the entire labor market um, going forward forever, right? There's some news stories I just saw, like folks coming out of college with just bachelor's degrees in business or marketing, things like that. Essentially, there's no job opportunities, right? And so those folks are going to have to find new careers. They're going to have to shift the way that they think about work. And just as big companies around the world are changing the way they look at their labor. So again, we're in this massive super cycle. I've said for the last 3 years, that this is the best investment cycle of our lifetime. It's something that is going to make us all incredibly wealthy as asset holders. And it's an unbelievable opportunity. With that said, obviously, we had a great year last year. We had a 5% outperformance. It was a phenomenal year. And that all got flipped on its head February 28th. The U.S. went to war with Iran. I'm not going to speak too much about the war. All I'll say is kind of the same comment I've been saying, which is it's annoying. I don't think that there's a lot of truth out there. I don't know that anybody truly knows what's going on. I have a friend who's in the Air Force. He's a loader. He loads big cargo planes out of Stewart Airport here in Newburgh, and he brings equipment around the world. And although he couldn't share with me any details about any of the missions as part of his job, he did share with me that he spent a lot of time in the beginning of the year bringing equipment overseas. And he spent a lot of time in April bringing it all back. So this is a ridiculous endeavor. This war with Iran really has no end in sight. I mean, we see obviously peace deal. We break a peace deal. Somebody bombs them. Israel bombs Lebanon. Are we in a peace deal? Are we not in a peace deal? Is it a real deal or is it just a deal to make another deal? I mean, it's garbage. It's mind-numbing garbage. And from a market's perspective, and again, when I say garbage, I don't mean the actual war. And again, I'm not even speaking about the mission. Not that I necessarily understand the mission. Or maybe we all don't understand the mission. What I'm saying is garbage is the news flow is garbage. It's all not true. Like anything we hear from this source, that source, none of it can be trusted. Some of it might be true, but we wouldn't know what's true, what's not. And so, but we're subject as investors to massive swings and changes in what's working in the market. And we have to deal with our assets being repriced based on essentially false information or no information. So oil spikes. Oil's over 100 barrels. It's back down to 87 a barrel, whatever it is today. But oil's through the roof. Inflation expectations are through the roof. Gas prices are through the roof. And so rates have climbed. So rates climb, and then all of a sudden your risk assets are getting hammered. Your commodities are getting hammered outside of energy. Energy's jumping through the roof. You've got energy stocks outperforming everything else. You've got consumer staples doing incredibly well. You've got the companies that are the backbone of this investment super cycle, which is going to change the entire world, getting hammered down 25-30%. Think Microsoft, Amazon. It's all backwards. And as investors, as investment advisors particularly, I have to deal with all this. And so I've spent the last 2 months dealing with it, trying to think about, are we wrong, right? I mean, we've had these themes, we've had these positions. I've been investing in large cap technology and hyperscalers in a large way since 2015. It's been an incredible run. These have been the winners, and they've been the winners because they have the best businesses in the world, right? Google, Microsoft, Amazon, Apple, NVIDIA nowadays. These are the best companies in the world. And yet, post the Iran war, stocks are down 20-30%. You've got energy stocks leading. You've got consumer staples leading. You've got total rotation. And I think, again, what I've had to do is I've had to reassess our thought, and you have to do that. I mean, you should do it all the time. We do it all the time. But sometimes when everything is shifting in front of you, you have to really assess and steelman the other side, the other argument, right? And say, is the market shifting permanently? Are we wrong? Are we caught flat-footed? And my answer for the last 2 months has come up, no. No, I don't think we're wrong. I think the market is undergoing a massive rotation and a massive shift that is being propelled primarily by geopolitical concerns over an event that we don't really know actually what's happening. So again, super, super frustrating. Frustrating for everybody. But we have doubled down on our belief that we're right, that the hyperscalers, that the AI trade is the right trade. And we use this opportunity when these positions were down to add to those positions. So we're playing offense in the face of this massive rotation, and that's what we're doing. And we're doing it, and we're going to talk about Amazon today. That's going to be our main story. I'm going to talk about some of the numbers, so I'll pull up a sheet. We're going to talk through some of the numbers to understand why Amazon's our top pick, right? Why we think this is the most incredible business on the face of the earth right now, and why we doubled down on that position and we think it could do incredible things over the next 18 months, 24 months, 36 months, much less 10 years. Before we get to that, I want to talk about a couple things. We're going to start talking a little bit about social arbitrage investing. It's part of our investment strategy. It always has been part of our research strategy. And essentially, I didn't coin that phrase; somebody else did, but I like it a lot. And we've taken it over as something that we do. We have a big focus on it. And essentially, what that is as investors, as managers, we're looking into the community, the social system. Social media is a great viewpoint into that. And we're looking at social media. We're looking at the conversations, the podcasts, what's on TV, what's in the tabloids, right? What is happening in the market or in society that maybe the market doesn't truly understand yet. And one of the big ones a couple of years back was GLP-1, right? And we were investing in AbbVie at the time, and that proved to be a great thing. And how did that come about? Well, GLP-1s were the talk of the town. Everybody you knew, listen, put it this way. Anybody that lost a bunch of weight in the last 4 years, there's a potential chance that they're on GLP-1s because they're an incredible drug, right? It's a wonder drug. And anybody that's, significantly overweight that's not using them probably should, consult with a doctor. I'm no physician, but at the end of the day, weight, excess weight on your body is terrible for you. So if you get rid of it, great. And these drugs did a great job. But before the market picked up on that, that was going on. That was through the community. That was being talked about. Same thing with AI, right? AI, somebody sent me ChatGPT in November 2022. and it started to pick up momentum. Microsoft obviously caught a bid at that point, but the market picked up on it, but the community was first, right? And we're always looking for what is the community, what is society dealing with, and then how does that going to formulate into opportunity in the markets. And we'll talk about Amazon again today is our main story, but Amazon is a great example of this. Same with Robinhood, right? For different reasons, but Robinhood is the story, right? If you're a young investor, Robinhood's offering a lot of different features, and they're doing a great job to bring in new customers to be investors. So we see that as a great opportunity. Same thing with Amazon. There are things going on in society, particularly AI and Anthropic and OpenClaw, that if you were just keep your nose, to the streets, right? You could start to see that permeating the conversations on YouTube and all that stuff. And if you just follow the cookie crumbs, you'll see, well, they're big investors in Anthropic, and they're partners with Anthropic on the cloud computing, data center side. So buy Amazon, right? Another big one is we'll call the peptide trade. Okay. If you listen to any big podcast right now, whether that's Joe Rogan or Andrew Huberman or you name it, they're talking about longevity. They're talking about peptides. Obviously the peptides started from GLP-1s, but now we're broadening that peptide conversation. And well, how do you invest in the peptide trade? Well, Hims and Hers is a great company that's got an opportunity with their partnership with Novo Nordisk to distribute GLP-1s, to get new client acquisition through that GLP-1 partnership, and then offer additional compounded peptides that focus on longevity in addition to testosterone and hormone replacement for women as they go through menopause. There are a lot of things that are being done on the science and health front that are in the community that haven't necessarily reached Wall Street yet. And as investors, if we could keep our eyes to the ground on what's going on and what's popular, that's going to inform the decisions about where we want to allocate capital. And these are huge, tremendous opportunities. So, with all that said, again, wanted to focus on a bit about, why we're holding steady to our thesis, right? And we look at Amazon as a great example. I'm actually going to share my screen. Let me see if I could do this. I'm going to put, there we go. There's the Amazon chart. So I'm going to kind of come to the side here. Let's see if I could point. Yeah, there we go. If you look at that Amazon chart, this is a 5-year chart. So if I went back to a 1-year chart, you could see really, again, we're at $236 a share. We were at 253 a share back in November. So it's been 7 months of no growth, essentially a year of really no growth. I mean, the market, we were back in July of last year at 234. So yeah, a year ago, we were the same price that we are today. Now, if you look at the 5-year chart, again, I actually want to focus on that blue line. The blue line in the bottom is the forward price to earnings. And the forward price to earnings today is 23 times forward earnings, right? That's what we're paying for Amazon today. This defies logic, all right? Because Amazon is expanding margin, they're growing earnings, they're in the midst of the greatest super cycle in stock market history, and yet we're buying it significantly cheaper than we were buying it a year ago relative to its forward earnings estimates. A year ago, it was trading at 49 times forward earnings. Today, it's trading at 23 times forward earnings. You can get Amazon today basically for market multiples. It's incredible, absolutely incredible opportunity. So I'm going to stop sharing my screen for a moment. All right, and let me pull up some of my data sheet because I don't remember all the numbers exactly offhand, so we're going to look at them. I'm going to pull the numbers up. So again, classically, if margins are expanding and the earnings are growing, well, then you're going to get a higher multiple for that stock, right? Because the stock's growing at a higher pace, so you're going to pay a higher multiple relative to its earnings. But with Amazon, we're buying it 19% cheaper on a price to earnings perspective than we were a year, actually 50% cheaper than a year ago, 19% cheaper than we were at the beginning of the year. Amazon is at a huge discount right now. It's incredible. We just went through Q1. They've got the highest operating margin ever in Amazon history, 13.1%, expanding margin. AWS, which is a driver of growth, accelerated 28% year over year. The backlog for AWS grew 90% year over year. Now $364 billion worth of backlog. That's revenue that's accounted for that they haven't received yet. AI revenue growing triple digits. The silicone business, their Trainium chips, they're now the third. They're in the top 3 data center chips in the world, behind NVIDIA and probably, I'm guessing Broadcom. You got NVIDIA, Broadcom, and then you got Amazon. So they're right there selling more chips than anybody else. They're in the top 3. They recorded a $16.8 billion pre-tax gain from its investment in Anthropic. So they put $5 billion in. They recorded a gain of $16.8 billion. This is a $340 billion company per year, and $16.8 billion just on one of their things that they own on their Anthropic position. They're now the second largest grocer in the United States. $150 billion in gross sales in 2025 on grocery. The perishable sales grew 40x year over year. The last piece is incredible. So they are now this business that has an incredible consumer business. They're now, right, the second largest grocer in the world. They've got this AWS business, which is growing like crazy, 28% year over year growth. Okay, accounting for huge, larger and larger percentages of the overall revenue. And that's fueled by massive backlog of spending, fueled by a partnership with one of the best AI platforms out there with Anthropic. And they're optimizing every part of the business. One of the things that they're doing right now, which is incredible, is they're taking, just like they did with AWS, right? They had excess compute, so they offered it to third parties to utilize it, called it AWS, and bang, there's a business. Now they have an LTL logistics system, right? It's called less than truckload. What they're doing is they're offering space on their trucking routes to third parties, right? This is going to increase their retail margins from 7% to 12%. So again, expanding margin, growing revenue, square center of the greatest investment cycle, and yet you could buy Amazon cheaper relative to its earnings than most of the market. There's something wrong with this, right? And this is where we have our money. This is where we've been making money, is owning these incredible companies that have resilience and growth, right? It's like defensive and growth at the same time. It's incredible, incredible business. And yet the market is discounting it, right? The market is just selling it. Kind of no regard for Amazon right now. Everybody wants to buy, some energy company or some, consumer staples, Coca-Cola, like perennial losers relative to the technology space, relative to the hyperscaler space. But that's the rotation that's going on in the first quarter. And again, as investors, we look at our portfolios, it's frustrating as hell, right? But it's not sustainable. What's sustainable is the growth in Amazon, the growth in Google, the growth in Microsoft. These are the businesses that you want to own. When we think over the next 24 to 36 months, that's exactly what happens, is these businesses take off. And we've added to the positions. We've taken opportunity here when the market is down to do so. And we're incredibly excited. And, Last thing I want to touch on just before we jump off, and it's Friday, we won't do too big of a podcast. I want to touch on gold and silver. Gold and silver for us has been a position we've held for many years. We added in a large part to that position in 2022, with all the inflation and stuff going on. We were buying it. Gold, as an example, $1,600 an ounce. Silver at $30 an ounce, and now those are $4,300 and $77 respectively, gold and silver. So we've seen incredible growth. However, gold is down 20% this year, right? So again, another part of this quarter that's been brutal to deal with is watching gold get sold. We think over the next 10 years, gold has an incredible runway. And that's based on the fact that the U.S. is, running 7% deficit to GDP every year. We're basically in a debt spiral. The world is de-dollarizing slowly. There's three ways that the world is on the dollar reserve currency. That's priced debt, that's priced assets, and that's central bank reserves. All three of them are diversifying. All three of them are adding in the gold positions. And the more and more we spend, which, it just happens every year, since I've been alive, the budget's going up every year and the deficit's going up every year. As long as that happens, it's going to continue to accelerate that. But in the meantime, we've got this war, and we've got oil spiking, and we've got, rates popping and the dollar popping. And so you got gold and silver and other commodities outside the energy sector getting hammered. So we're all dealing with this tumultuous environment, and it's testing our conviction on our positions. And that's okay. That's healthy for that to happen. And what you just want to make sure you're doing as an investor is you're getting introspective in these times. You're reviewing those positions. And trust me, I've reviewed every single position I own. And every one of them, I say, how could I sell this right now? How could I get out of this position? I know it's underperformed slightly this quarter. Hasn't in the last 3 years, but it has this quarter. Why? And what does that change in the future? And the answer overwhelmingly has been, it's a rotation, it's war, it's rates, it's oil, it's inflation. And we think that changes, right? And we do think that fixes itself, and we can get back to this super cycle. And Amazon, the reason we reviewed some of those numbers, say it is our highest conviction position. We believe more in Amazon than any other company. And so we added to it, and we think it's going to do incredible things. And, to button up on the gold thing, we think gold is a $10,000 an ounce asset in the next 10 years. And you want to own that well before you want to own bonds that are going to suck wind for the next 10 years. And so that's why we own them in part of our bond portfolio. We own our gold and silver positions. And we're holding through that, right? We have conviction in those positions. Those are long-term positions, as everything we have is, right? We are long-term investors, and we think, we're well positioned for this super cycle. We're going to continue to, again, keep our ear to the ground, to the streets, and try and understand what's going on in society, and then look for those arbitrage moments. What does the society know that Wall Street doesn't? Because at the end of the day, there are a bunch of billionaires in banks that are a bit disconnected. And that's the advantage that we have as smaller investors, as everyday people, relative to these multi-billionaires that maybe don't necessarily get it all. And that's the advantage. And that's what we're going to do. So anyway, thank you for taking the time today. Wanted to, again, just express where we've been on this, these market events that we've seen the last 2 months. It's been a challenge nonetheless, but that's part of the gig. And, we're happy to have been forced into this review, because again, it's done nothing but strengthen our positions and given us the opportunity to add to those positions. And I think we're really set up for an incredible back half of 2026. And hopefully we can find some peace in the Middle East and we can get back to it. All right. Everybody enjoy your weekend, and we'll talk to you soon.